Imagine walking into a bank in the United States to borrow money. Before anyone asks for your pay slip, before anyone cares about your savings, there's one number that can literally decide your financial future. Not your salary, not your credit score. It's something most Americans know, but many Europeans, especially French people, find completely bizarre. It's called the debt to income ratio, or DTI. And today I'm breaking it down French style so you'll finally understand why this number controls who gets a mortgage in America and who doesn't. Bonjour à tous. If you're French and curious about how American personal finance works, especially why Americans borrow the way they do, you're in the right place. In this video, I'll explain the American debt-to-income ratio, how it's calculated, why it matters, and how it compares to French lending rules. This is your clear, simple guide to understanding the US credit system. So what exactly is the American debt-to-income ratio? In the US, banks and lenders rely heavily on DTI to decide whether someone can afford a loan, like a mortgage, a car loan, or even certain credit cards. It's a simple calculation. DTI equals total monthly debt payment divided by the gross monthly income. Yes, you've heard that right. Gross income, not net. Americans calculate their borrowing capacity before taxes, something that shocks many French people since in France borrowing is usually based on net income. For example, if you earn $5,000 a month before taxes and you pay $2,000 a month on debt, student loans, car loan, credit cards, etc., your DTI is 40%. In the US, this number tells lenders almost everything they need to know about your repayment ability. Why DTI matters more in America than in France? Here is where things get interesting for French viewers. In France, the key rule for borrowing is the taux d'endettement, capped at around 35% based on net income. Banks also consider your long-term financial ability, your employment contract, and your savings. It's more protective, more regulated, and less flexible. But in the US, DTI is king. Why? Because the American system is built around credit scores, private lenders, and risk-based lending. Two people with the same income may get totally different offers depending on their DTI, credit score, and debt history. So while France focuses on limiting your debt, the US focuses on whether you're historically been good at paying it back. What debt counts in the American DTI? Here's what's included in the US DTI. Mortgage payments, credit card minimum payments, student loans, auto loans, personal loans, child support, and alimony. Notice what's not included: groceries, health insurance, utilities, taxes, daily living costs. This can be surprising if you're French, because the French banking system evaluates more of your total living situations. Meanwhile, Americans are judged mostly on formal debt, not everyday expenses. So what is a good DTI in the US? If you're French, you probably think 35% is a maximum allowed. But in the US, the limits are more flexible. Here is the usual breakdown for American lenders. Below 36%, considered excellent. Between 36 and 43%, acceptable for many mortgages. 43 to 50%, risky but still sometimes approved. Above 50%, very unlikely to qualify for a mortgage. For French people, this can feel very high. But remember, Americans typically have more types of debt, especially student loans and car loans, so higher DTIs are more common. Why the US relies on DTI, the credit score system? To truly understand the American debt-to-income ratio, you also need to understand the American credit score. In France, your bank knows your finances personally and stays with you for life. In the US, lenders rely on your credit score, which tracks payment history, credit card usage, length of credit history, type of credit. Your DTI and your credit score work together. A great credit score plus a good DTI equals low interest rate. A bad credit score plus a high DTI equals no loan or very expensive loan. This system makes the US credit market more dynamic but also more risky. Real life experience, American versus French borrowers. Let's compare two people, Paul in France and Michael in the US. Each earns the equivalent of 50,000 euros per year. Paul in France, his net monthly income is about 3,000 euros. Maximum debt allowed, 35% or 1,050 euros. He's already has a 300 euro car loan. He can borrow up to 750 euros for a mortgage. Here's Michael in the US. His gross monthly income is $4,166. His allowed DTI for many loans is up to 43% or $1,791. If he has a $400 car loan and a $300 student loan, he can still borrow around $1,100 a month for a mortgage. This means Americans can often borrow more, but they also take on more long-term debt, especially for education. What French people often misunderstand about American debt. French viewers often ask, why do Americans can take on so much debt? Because the US system encourages debt as a tool to build credit. Why aren't taxes and living costs included? Because the US assumes you manage those separately. Why base loans on gross income? Because American lenders use standard ratios, not personalized budget. Why isn't there a strict national limit like in France? Because the US banking system is far less regulated, giving lenders more freedom, but also creating more financial risk. So there you have it, the American debt-to-income ratio explained in simple French terms. Americans borrow based on DTI, not net income. The US system is built on credit scores and risk-based lending. Debt is more common, more accepted, and more central to financial life. Compared to France, Americans have more flexibility but also more responsibilities. If you want more videos comparing American and French money habits, taxes, mortgages, and culture, hit like, subscribe, and drop your questions in the comments. Thank you for watching. À très bientôt.